Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business and finance so you can understand what is really going on. Today we are diving into Protagenic Therapeutics Inc.'s latest financial report, and let me tell you, it is a journey with some twists and turns that are quite unlike many we've seen before we jump in. If you appreciate getting straight, no-nonsense insights from these filings, make sure you are subscribed. Also, we have a fantastic Discord community where we continue these discussions. It is linked down in the description below. Let's get right into it. This report is essentially a checkup on the company's health and its game plan up to the 30th of September. 2025, and boy has there been a lot happening. First off, Protagenic Therapeutics Inc. Now operating under the ticker PTX is a company focused on creating new medicines, especially for brain and mood disorders. But lately, their story has more to do with big changes and getting their house in order than just drug development. Looking at their balance sheet, which is like a snapshot of what the company owns and owes, we see a huge jump in assets. On the 30th of September 2025, their total assets were about $5 million, up from just $89,000 at the start of the period. This massive increase comes from something called a reverse merger, which we'll talk more about, and the addition of intangible assets like patents and research valued at over $2 million. But on the flip side, their liabilities, what they owe, also shot up to nearly $10 million. This means they have way more debt than assets right now, a common situation for companies in their stage, but still something to watch. Now for the income statement, which shows if the company is making or losing money, for the 3 months ending the 30th of September 2025, they reported a net loss of almost $870,000. That is a lot more than the around $582,000 loss in the same period last year. This bigger loss largely comes from increased spending on research and development, plus higher salaries and wages as the company scales up. For the 6 months ending the 30th of September 2025, the loss from operations was a whopping $3.4 million compared to just over $677,000 in the previous year. A big part of this jump is due to a write-off of receivables for over $1 million. This means they expected to get money from someone, likely related to a past deal that fell through, and now they are accepting they likely won't. The statement of stockholders' equity shows how the owner's stake in the company has changed. Here we see the impact of all the recent transactions. For example, the company issued new shares for the merger and from warrant exercises, leading to a dramatic increase in additional paid in capital, which is basically the money investors have put into the company beyond the stock's face value. It shot up from $455,000 at the start of the fiscal year to nearly $7 million by the 30th of September 2025. However, the accumulated deficit, which is the total losses the company has ever incurred, is over $11 million. Showing the path to profitability is still a long one. The cash flow statement tells us where the company is getting its cash from and where it is going. For the 6 months ending the 30th of September 2025, the company used over $2.5 million in operating activities, which is common when you are developing new products. Interestingly, investing activities provided over $943,000. This cash came as part of the Phytonix Bio acquisition. Financing activities were a big source of cash, bringing in over $4.4 million. This came from selling stock, warrants being exercised by investors who want to buy shares, and some loans from related parties, which is common in early stage companies. This report talks a lot about a big event, the acquisition of Phytonix Bio Inc. This wasn't just a simple purchase, it was a reverse merger where Phytonix Bio, a company focused on developing cannabinoid-based products, became the accounting acquirer. This means that for accounting purposes, Phytonix's financials are now the main story, and Protagenic's pre-merger history is less relevant. This merger happened around May 2025 and brought in new drug candidates and employees. The company is very upfront about its situation. They have a working capital deficit and a huge accumulated deficit. This really raises doubts about their ability to keep operating in the future. They need to find more money either through loans or selling more stock by March 2026 to keep going. This is a really critical point. They are on thin ice financially. They highlight something called ASEC 805-40-45-1, which is a technical accounting rule. Basically, with this reverse merger, the old Protagenic financials are less important than Phytonix's. The combined company's financial record starts with Phytonix's history. This means the numbers we see from before May 2025 mainly reflect Phytonix. This section highlights some complex financial instruments. They issued promissory notes and warrants, which are like options to buy stock. Because these warrants have features that can change based on stock prices, they are treated not just as simple debt, but also as derivative liabilities. This is a fancy way of saying that the company owes money. but also has a financial obligation tied to the value of its stock, which can swing wildly. This created a significant liability on their books, over $3.6 million by the 30th of September 2025, and it grew substantially. This kind of instrument is often used to raise money, but it adds a layer of financial complexity and potential risk. Here we see the impact of all these share issuances. Millions of shares were issued in the merger and from warrant exercises. The value of additional paid in capital, which is essentially investor money, grew dramatically. But remember that massive accumulated deficit we saw earlier. It is still there, showing the company's history of losses. This is where we learn about potential future obligations and problems. They have licensing agreements with the University of Toronto requiring royalty payments on any future sales. Also, there is a significant issue with Nasdaq, the stock exchange where they are listed. They received a notice that they were not meeting the minimum bid price requirement for their stock, which needs to stay above $1. They've been working hard, including a 1-for-14 stock split, to try and fix this. But they also received another notification about not filing their report on time, which could lead to them being delisted. This is a major risk for any publicly traded company. And then there is the situation with Axiom Real-Time Metrics Inc., a company they did business with. Axiom has gone into receivership, and Protagenic is highly unlikely to get back the funds it claims it is owed. This highlights the risks of doing business with other companies, especially in volatile industries. This part is management talking about what is happening. They are very clear that they expect to keep losing money for the foreseeable future as they develop their drugs. They're hoping to raise more money and have a plan to get their drug PT-00114 through clinical trials. However, they acknowledge that their cash might only last them until the second quarter of fiscal year 2027. They are also working on a restructuring plan to become a virtual operating model, meaning fewer employees and less office space to cut costs. This is a really important part. The company admits to having material weaknesses in their internal controls. This means there are gaps in how they manage their finances, like not having enough people to check each other's work properly. This could lead to mistakes in their financial reporting going undetected. They are hiring outside help to try and fix this. But it is a serious issue for a public company, so what is the big picture here? Protagenic Therapeutics is in a high-stakes game. They've clearly made a significant strategic move with the Phytanix Bio merger, bringing in new potential products and a lot of intangible assets, but this has also dramatically increased their debt and complexity. The company is burning through cash fast, and its ability to raise more is critical for its survival. The Nasdaq delisting risk is a huge red flag, and the admitted weaknesses in financial controls add another layer of concern. However, they are moving forward with a focus on their lead drug candidate, PT-00114, and trying to make their operations leaner by becoming a virtual company. The success of PT-00114 in trials and their ability to secure much needed funding will ultimately determine their fate. It is a classic biotech gamble with high potential rewards but equally high risks. What do you think about Protagenic's latest report? Are they on the right track, or are the risks too great? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate financials. And hey, check out our Discord community linked in the description. It is a great place to continue the conversation. Thanks for watching, and we'll see you on the next Corporate Decoder.